We are here to discuss whether, how how AI is affecting wealth management and the investment landscape. And we would like to look behind the marketing brochures. So we're here to talk about operational realities. We're here to talk about institutional liability and the structural risks facing Central Eastern European capital. And our panelists today, they represent development economics, they represent venture capital, they represent alternative asset management, and also wealth advisory, wealth management. And so we're joined by Alex Nemeth from Shape Capital, from Alex Elian from Blue Rock, and also Marco Giovanni from IFC from Vienna, and of course by Vlad Miku from Inno Investment. And what I would like to do is I would like to start with dissecting this technological shift piece by piece. On one hand, AI is slashing operational costs, doesn't it? And taking financial productivity to an entirely different level. On the other hand, it threatens to overflow the current industry structures on both public markets and also private markets. It also raises serious questions regarding digital sovereignty, for example. And the first question is for Andreas. Let us start with this productivity paradox, what I would call. It is a massive efficiency boom. So is it a blessing? Is it an unmitigated blessing? Or is it actively disrupting the very foundations of the investment industry?
So I can give you the private markets perspective on it. So we will also discuss the public side of things. But as Shape Capital is a VC fund for targeting tech companies in Central and Eastern Europe, I can only give you the perspective from what we see in the private markets. And to your question, it is truly transformative, what we are seeing. We are ourselves also leveraging AI in our internal processes. And we see that it makes it much more efficient, what we are doing. So I think there are two dimensions of it. You have mentioned the productivity gain and the cost reduction. Actually, we are definitely seeing that. But at the same time, I think making markets more efficient can also mean that it makes it more transparent. So I think, and that is maybe also the risk a bit that we see. Are you still in need of venture capital allocators, managers, or is the market now becoming so transparent because you can ask AI actually every question you want to have about due diligence processes and so on and so forth. So yes, we see there is a tremendous productivity gain and it makes markets more efficient, but that is definitely cure and curse at the same time, if you are an incumbent manager in that space.
Thank you for that. And Mirko, a question for you. Could we take a broader macroeconomic view from Vienna? As alternative asset managers and regional platforms, as they deploy these intelligence tools, what are the systemic risks? How do you see it? Are we building true regional digital sovereignty? Or are we creating a rather dangerous, potentially, total dependence on the United States hyperscalers and also foreign, foundational models? What do you think?
Anton, thank you very much. So let me start by saying that, the usual disclaimer applies. So my views are not representing any of the institutions that I worked with before. But before going into the sovereignty question, can I just add a slight provocation to what Andreas mentioned? Because I totally agree with the efficiency point. But I think when we talk about AI, the immediate answer is about the short-term visible cost. But from a macroeconomic point of view, there's a lot more beneath the carpet. So I'm thinking about the difference between consumption versus utilization. Usually, enterprises are paying for subscription models, but actually the token usage is way higher. So that's sort of like a hidden cost that we should be monitoring. Model integration. If you don't rely on open source, which is a very cost efficient method, and you want to integrate model internally in your workflows, that's a lot more costly. And also auditing. I mean, let's not forget that the EU regulation requires full accountability of these models. So you cannot just blame the model. You need full auditing of the model, and that's costly. And then when it's with respect to systemic risks, this is the ECB Financial Stability Review of November 2025. They clearly pointed out at vendor concentration and herding as critical risks. So if all firms, if many firms are relying on a handful number of models, trained on the same data, bought from the same vendors, I think that's not diversification and market efficiency. I think that's really a synonym for systemic risk. So I agree with Andreas on market transparency, but that's also a systemic risk angle that we should really be careful of. In terms of sovereignty, quickly, Anton, I believe that oversimplifying the sovereignty question as a yes or no answer is just misselling it, right? Sovereignty, to me, should be addressed as a multi-layered sort of framework. So let's look at 5 of them. I think we should start from energy and compute infrastructure. Then the second layer would be foundational models. Then we have data, talent and applications, and rulebook. You can't just generalize we are dependent or not dependent if we don't look at these things. So in terms of foundational models, because your questions pointed directly to that, I believe we need to be brutally honest. So on the first 2 layers that I mentioned, strategic dependence, at least from the European perspective, is deepening on US hyperscalers. According to the Stanford AI Index, in 2024, the US produced more than a half of all significant AI models, whereas Europe only produced 6% of them. And then if you look at data centers, AI specialized data centers that are controlled by US and Chinese companies, the number is over 90%. So clearly there's a dependence. But dependence is not a static. It's not a static feature. It's a variable, and we can look at it from. I give you 2 examples: the Brexit perspective and the Russian energy perspective. We were super thrilled. we were super scared back in 2022 because we were really dependent on Russia. What happened? Through regulation and through industry push, we managed to bring down gas dependence from. Sorry, is it better now?
Yes.
Right. We managed to bring down imports of European gas from Russia from 45% in 2021 to 12% in 2025. And that's a combination of regulatory push, Repower EU as a regulation, as well as market actors. Brexit and the CCPs, the derivatives and market clearing issue, I think that's a failure, right? So that gives an idea that dependency can be treated, can be addressed, but we need to be clear on what sort of network effects are there, and if the market is preparing before the cliff edge or after. So timing and let's say stickiness of dependence is of a critical importance.
Well, thank you for this perspective. Let us now move from the cloud infrastructure to the actual deployment of capital in alternative assets. So the question is for Vlad now. Vlad, Inno Investments operates as a subsidiary of one of the biggest banking groups in Romania, Banca Transilvania. You specialize in alternative investment funds, aiming to scale VC, private equity, and sector-focused thematic funds in a developing, nascent Romanian market. So historically, regional funding pipelines relied on fragmented data, on manual underwriting. How does advanced AI re-engineer how you model predictive asset pricing and evaluate long-term risk for alternative funds in Romania? But also, does the machine speed complement traditional banking structures, or does it actually bypass them?
Good afternoon, everybody, and thank you for bearing with us in such a beautiful day. So indeed, Inno is one of the youngest subsidiaries of Banca Transilvania Group dealing with alternative investments. We operate across asset classes, and we run a small real estate fund. And now, coming back to your question, it is known or said that AI predictive engines have efficiency, accuracies of up to 94%, as long as there are no issues of data accuracy or transparency. In Romania, unfortunately, we operate in a market where we have exactly those kind of issues. So it is well known we do have issues of transparency, and we do have inconsistent data historically. So that makes adoption of AI algorithms a bit more challenging than maybe in other geographies. Nevertheless, we improve efficiency by utilizing automated valuation methods. You end up getting results quicker and sometimes cheaper. We have ways to have better forecasting as long as you define correct growth criterias and you follow them up. You might understand better at what time you can do a deal, whether buy or sell. Or you can easily screen the markets quicker and cheaper. So obviously all these things impact. However, human expertise and human factor remains instrumental. In our case, we need to validate results that are returned by the algorithm in most of the cases. So I'd still say that somehow advanced technology comes to add on the human factor. And at least for us, we still base our models and business a lot on human factor, while trying to improve efficiency based on AI.
Thank you, Vlad. A question for Andreas. As data becomes universally accessible via these advanced engines, what happens to the competitive landscape? Does this democratization of information help regional CE funds attract global liquidity? Or do you think it's quite the opposite? It strips away the traditional local advantage that regional managers used to have?
I think it's not adding more money. I think internationally we're attracting more, because I think the region has traditionally attracted a lot of foreign investments into private markets, just because there is not enough actually supply locally. So I think that is not changing. So is it easier to operate now cross-border or from outside into the region? What I've also told you before, we heavily leverage AI nowadays in our internal processes, and we can streamline a lot of things. We can automate a lot of things. Everybody else can do that. And like we've heard before, I think it's everybody has now the same abilities and the same models. But at the same time, it makes us very much think about what actually are we adding then as a firm, as a partnership. What are the unique propositions that we can actually build our competitive edge on? And I think it's still people, it's still the relationships that they have, because AI is not yet there to build these relationships themselves. It's still data that is maybe not easily available to every other part of the world. So I think there are some unique modes that you still have also in the age of AI, but I think it rather makes you really think about them in a more structured way. So I think it's there will be local players still having an advantage because of local personalization, personal adaptation. But I think it's not the one or the other, but I think it's the question of how to combine what you can do locally, what you can leverage on a more global scale.
Well, thank you, Andreas. Let us address the human cost of automation. The US Securities and Exchange Commission has warned against taking the human entirely out of the loop. And the question for Alex, as a wealth manager, you operate within the European regulatory guardrails, so to speak. You face obviously strict fiduciary duties to your clients. So you cannot legally offload liability to a software developer or a black box algorithm, particularly if a model fails. So how do you maintain absolute regulatory compliance when your advisory and asset allocation frameworks rely on engines, particularly if your compliance committee cannot fully verify them, cannot fully audit them?
Unlike my colleagues, we live in a world in which we have to make decisions much, much quicker because we trade in active stock markets. Hence, for us, AI is a help because it helps us crunch numbers much, much faster, and we can actually screen far, far more data than we could have done manually before. That being said, responsibility lies exclusively with the stock brokerage firm, with the people actually making the investment decision, and liability lies also exclusively with the people making the decision, and both are human. There is absolutely no way that we can let a black box model make decisions that we are unaware of and cannot be held responsible for. So for us, genuinely, AI is a fast, wonderful, and most of the time reliable computer that can crunch data fast and help us and do the work of many juniors. But that is where, at this particular moment, this ends for us.
Thank you, Alex. A question for Vlad.
Can I maybe add something? Because I totally agree with what Alex said, but I think the accountability issue should also be maybe viewed from additional two push perspectives. So the first one is the regulatory side of it, right? So the EU AI Act is super clear. And also ESMA, so the European Security and Market Authority, they're super clear. So according to the EU AI Act, credit scoring, for example, lies within Annex 3, which is the high-risk decisioning. And that's really a cost. So if you don't comply, like fines can go up to 7% of your global turnover. Really sizable. But moving beyond regulation, I think, and this circles back to one of the earlier points that I made in terms of hidden cost, research on human-in-the-loop systems actually provides some quite of a saddening evidence. The humans tend to defer the decisions systematically to the models. Now, if you don't hold anyone accountable, as Alex perfectly mentioned, long-term, from a macroeconomic point of view, the risk of losing human capital is huge. Because, at least in finance, what we do is from the junior stuff, we lose the capacity to judge. And the pattern recognition ability comes, at least in finance, comes from doing the heavy work. Staying up all night at the desk, up until 2, 3 a.m., like doing really greedy stuff. And, if you just simply click approve all the time, then this judgment ability and the strategic stewardship ability, 10 years down the line, you would be sitting in a room with 10 other senior managers who don't really understand, to my point of view, why they're doing something and what they're doing it for. So accountability should also be seen, in my personal point of view, not only from a regulatory point of view, but also from a human capital risk, loss of human capital risk perspective.
If you don't have juniors, you will never have seniors.
Exactly. Well, a question for Vlad now. When Inno Investments utilizes algorithmic screening or predictive frameworks, when you build your alternative asset portfolios, where does the machine stop? And where exactly does automated data intelligence end and disciplined human investment governance begin? So that's the question.
I don't think there's a clear answer to that question, and there's no dotted line, that simply separates between the two. Because if you look to the entire universe of the actions that we take, one extreme you have, for example, redundant processes that have been automated via RPAs, where the human impact is really minimal. Yeah, so this is one extreme. The other extreme is the phase in which you structure deals and you negotiate deals where the AI is not relevant. So these are the extremes. Anywhere in between, you have all sorts of other operations that you do, be it, valuations, be it market screening, be it forecasting, and there human factor combines with AI in different magnitudes. So this is really it. So there's no dotted line. Again, human factor and AI works in complementarity. AI, it's a tool, but human factor is really, really important throughout the process.
And let me build a bit on what Vlad said, because I fully agree. I think, we are sometimes internally now, when using these different models, Claude, Codex, whatever, we are always referring to the software, to the technology as the apprentice. Because you have to talk to the AI like if to any apprentice or junior member of your team, who is actually relentlessly working, going the extra mile day and night. But basically, you have to tell the machine what you actually want, and you have to be somehow a more experienced senior person, not a guru maybe, but to direct actually the action of the AI. So I think it's a bit overrated maybe that we are thinking of AI taking over the jobs or financial markets, although there have been computer automated trading solutions also in the past. But I think it's now rather that we can actually automate a lot of this boring work, but it doesn't free us from really taking the tough decisions, the gut feelings. Yeah. So I think it's just the human instinct is more important than ever, and we have to also do a lot of supervision of the AI still.
I think the people asking the questions must be knowledgeable enough to be able to detect errors of judgment in the answer. And that's something that people don't quite get it. They just assume that if they ask a question, they will get the answer, and the answer will be largely correct. That may or may not be true.
Thank you. The question for Mirko, I would like to look us at the macro stability in the CE region. So from an international development perspective, what is the ultimate impact of this digital transition on regional stability? Does the widespread availability of AI tools shield CE capital from external macroeconomic shocks? Or does it create automated pathways to actually accelerate the exodus of liquidity during, say, periods of, volatility, global volatility?
So, Anton, I think this is a very interesting good question. And I'm an economist by formation. I remember when I was at university, I hated when I would ask, questions to my professor, and he would just answer, well, it depends, or yes or no. So I'll give it back to you. And I think the answer is neither, because that's that very, very simple reason, because I think AI, you can think about it as an amplifier, not a compass of capital flows. I mean, I'm coming from a macroeconomic, background, and I do believe, and I still strongly, fundamentally believe that capital flows are driven and determined by macroeconomic fundamentals, including market depth, not the speed or the intelligence of any algorithm, right? So let's look at a very recent example, which is the February outbreak of the Iran war. Right. So, I might want to speak a little bit of technicalities, but this is a finance audience, so I guess everyone can follow. So before going into the war, what happened is the macroeconomic scenario was a positive one, right? Resilient growth, moderating inflation, elevated valuations, and compressed risk premiums on the back of also AI productivity optimism. But when you go into the shock, and the shock occurred, then a textbook sequence happened, right? So there was correlated flight to safety across insurers, pension funds, investment funds, through simultaneous, de-risking of positions, falling prices, redemption pressures, as well as margin calls, dynamics that threaten liquidity stress, on top of an energy supply shock. That made it a little bit more difficult. But then if you look at this is just standard sequence, right? 1997, 2008, 2020, nothing changed. What changed is the speed of the transmission. And the speed of the transmission is driven by, the adoption of AI. Think about that. According to some statistics, between 60 and 80% of equity trading volume is determined by algorithms. And 9 out of 10 hedge funds are actually using already or planning to use AI tools. Now, looking at CE region specifically, if you overlay these statistics with, on top of a already very shallow CE order books, subscale national exchanges in the CE region are actually, their equity market cap is in the low double digits of GDP. If you compare it with, Western capitals, that's 3 times, 4 times as much. So overlay that with a already very shallow CE order book, and then the shock that happens through textbook sequence compresses from weeks into hours. That's the only thing that changed. So I think if I need to be provocative, and please allow me to do so, I think when we ask, is AI draining liquidity? I think that's the wrong question. Because liquidity to me is already going elsewhere. Like, AI giant or automation giant in the region are already listing somewhere else. And if you give access to retail investors in the region, they're probably going to buy European ETFs or American ETFs. So liquidity is already leaving. If you want the liquidity to stay, you need to give liquidity a reason to stay. And that's reason to stay for me is debt, market debt, listing pipelines, and especially for the CE region, credibility of institutions. How do you build that? Well, we mentioned pension funds, the savings and investment union regulatory packages, so critical importance. And then we also mentioned manufacturing transparency, because you need to make these issuers legible to global institutional capital. Because if they don't understand what it's inside, they'll never invest. Or if the shock happens, it's going to be an exodus rather than a correction.
Thank you, Mirko. I'm getting signs from the organizers that we're running short on time. So I'd like a final in the end. I'd like from each of you closing predictions. What is the one specific irreplaceable human element in the C investment relationships and wealth management, but generally as well, that an artificial intelligence algorithm cannot and will not be able to replicate? Is there one specific thing that you feel AI will never be able to replicate as a human? It will not be able to replicate a human. From all of it.
I'll start for that. So I think it's the relationship you just mentioned. That's what it cannot be replicated by AI. And to me, this means on one hand, advice during crisis. So it's competent advice. It means ethical judgment, and it means empathic communication. So I will come back to it, and I'd say relationship.
For me, at least today, AI cannot replicate out-of-the-box decisions, i.e. things that cannot be easily streamlined, put into a spreadsheet, and have nice little formulas coming out of.
I want to go back to this example of this apprentice idea. I think it's what humans are so capable of is actually growing personally. The machine will always add percentage weights on different questions and then not decide, but rather suggests or bet on the right outcome. I think what humans are actually much better in, I think, is that really learning by experience over time.
Mirko?
So, we heard trust, so I'll try to be a little bit more romantic, because we mentioned that there's a very big AI innovation gap with the US. So, I think if you look at VC, flows, I think what AI can really not replicate is to walk into a room, look the investors, co-founders, the team in the eye, and feel their energy. I think it is overstated that capital flows are arithmetically driven by business models, business plans, financial forecasts and metrics. The human touch, feeling their energy, understanding the investor's background, also sensing their motivation and their drive. That's something that no machine, however conscious or however advanced it is, will ever possibly achieve.
Well, we must draw our session to a close, and our discussion today makes one reality very clear. The integration of cognitive capital into C investment and wealth management is not a simple software upgrade. It is a fundamental re-engineering of institutional trust, regulatory accountability, but also asset valuation. I just wanted to thank all the panelists and thank you to the organizers, and enjoy the rest of the event.